Well, good afternoon, everyone. Sorry to cut off Mr. Jackson there. I hope everyone enjoyed the hold music, and welcome to Narwhal's third quarter macro presentation for 2020. We are super excited to have everyone here, and we got a full program. So I'm going to run through some quick housekeeping, and then we'll get things moving along. First of all, just like the last macro, we want to do a Q&A at the end. So if you have any questions, whether they are general or specific to this presentation, use the chat feature on Zoom to send them to me personally, or if you're bold enough, send them in the group chat, or you can always email me at lburton@narwhalcapital.com. We'll try and answer everything at the end, depending on time. And also, if you aren't able to stay for the entirety of this live presentation, but you want to check out the rest of it, we will be posting a full recording as well as the slides tomorrow on our website. So check out narwhalcapital.com/blog to access that recording. And I'm going to put in the group chat here a link to all of the slides that Ben will be going through. Just that way, if you want to go back and look at stuff as we're rolling through a lot of information, it'll give you an opportunity to kind of get eyes on the data on your own screen. So check out the chat function in Zoom to look at that link. I do want to look quickly at the disclosure before we start. So before we begin, this presentation consists of our own internal research and observations and should not be construed as investment advice. So if you have questions about your own investments based on the content here tonight, please don't hesitate to contact us directly. All right, let's get into the third quarter. Uncertainty is one of life's great stressors, and the uncertainty that we see today is tangible and real. There's politics, there's the pandemic, protests, and paychecks. All of this uncertainty often leads to a state of perpetual worry that can be challenging and even debilitating at times. Most of us deal with some level of uncertainty in our daily life and in our work lives. However, we can deal with it because it has a finish line and because we've learned how to compartmentalize it. But in today's world, there are larger movements of change that seem almost impossible to understand or control. And so many of us face this daily challenge of choosing how much we worry about the world around us. This afternoon, I hope that these facts and realities that we're going to present will provide some much needed relief to that worry. Our goal is to present facts with a clear mind and in a focused manner. And in a period defined by extreme pessimism, any optimistic outlook can seem unrealistic. But we believe that our assessment tonight is not only realistic, it's fair, it's hopeful, and it's grounded in concrete research. We're going to begin with a review of the larger economic picture with emphasis on COVID data and the state of the rebounding job market. We'll move into a closer look at the markets with both a review of the third quarter and an outlook into the end of the year. Finally, we'll wrap up the discussion on politics with a closer look at election odds and a deep dive into the Biden tax plan. Throughout the presentation, I'll be popping in to take some quick polls on questions that we find relevant and interesting. If you're on a smartphone or computer, you should be able to see these polls and take them, and keep in mind that all the answers are anonymous. If you're just listening, I'll read the results after the majority responds. And all the questions will be answered in whole a few slides later after we ask them. So we'll start with our first poll right now. You should be able to see this on your screen. It is coming up right now. How do new home sales in September of 2020 compare to new home sales in September of 2019? All righty, I'm going to pass it off to Ben to get started on a look at the American economy.
Thanks, Luke. So looks like everyone's fairly positive on home prices, and that seems to be the sense espoused by our president as well. There are really two ways of looking at this economy right now. There's the glass half full, there's the glass half empty. President obviously has the glass half full approach, or maybe even overflowing approach. He says on September 12th, and he said it subsequently, that the country's coming back. It's a super V. It's beyond a V. It's a super V. And obviously there's another side to this coin. And so we're going to explore that over the next 20 minutes or so in this part of the presentation. Talk a little bit about what the economy is doing, how we're reopening, and the speed to which we're reopening. And that all starts with the coronavirus. And so we'll touch on a little bit of this here. So here's the tests, the new cases, the current hospitalizations, and the deaths. And there are a few key takeaways from this. The first, very clearly, is that our testing has ramped up substantially. We're now testing almost 1 million people a day. That ramps up from, remember, if you think back to March and April when this thing was first breaking out, we were testing fewer than 200,000 people a day. So testing has ramped up a lot. And part of that probably contributed to the second wave of new cases that looks higher than the first. In all reality, it's difficult to really know how high that first wave was because the testing, as you can see, was much less. But clearly, if you look at current hospitalizations or even new deaths, unfortunately, there was a significant second wave breaking out in middle of June and really lasting through the middle of August. And that's not to discount what's happening right now, but it is to say that there was a time when we were worse off in terms of coronavirus than we are now. The other thing that I draw your attention to is the new deaths. If you look at the second wave of deaths, clearly that was lower, not good, with more than 1,000 people dying per day of this disease. But thankfully that has backed off. But importantly, that second wave was significantly lower than the first wave. And there are a couple of reasons for this. The first reason is obviously that the cases may have been concentrated among a less risky population, i.e. younger, healthier. And the second reason is that the medical community has figured out more of a standard of care that can improve patient outcomes beyond just simply putting newly admitted patients on a ventilator and not really knowing how to handle this virus. So that's the national view. But as we are all aware of, this thing has, it moves from pocket to pocket. And we've definitely seen that happen. The first pocket, first wave was in the Northeast, followed by the South. And the South has the largest population, so that wave is always going to look a bit bigger because on 315 million new cases out of 1 million people, but if there's 126 million people in that area, there's going to be just more absolute numbers of cases. The West did have a spike, but it wasn't as high as the South. And right now, the Midwest is right in focus, and that's where the spike is happening now. So unfortunately, this thing does pocket up, and it does seem like each region has experienced some sort of spike or is experiencing a spike. And so that we just have to be aware of that. Thankfully, though, we haven't seen second spikes in any of these geographies. Even if you look at the Northeast, you're seeing a bit of an uptick recently, but nowhere near where it was in March and April. And part of that is we're learning how to deal with it a little bit better, and we're also learning how to treat it. So I was actually corrected on this slide because my initial slide wasn't the absolute standard of care. I actually talked to an Emory doctor to get his input on this, and there's really two levels. So the first level is if you have coronavirus, the first thing that they'll do is, as long as your oxygen levels remain okay, you're to treat the symptoms and use certain supplements which have been shown to improve your outcome, improve the recovery time, and that's vitamin C, vitamin D, thiamine, which is vitamin B, and zinc. So those are certain things that you can do if you don't need oxygen, if you have a relatively mild case. Now, if you do need oxygen, that's where they have these graduated cocktails that they provide. And the first is remdesivir. Remdesivir is a drug, an antiviral that Gilead produces. And what it has been shown to do is actually, it's been shown to reduce the hospital stay and speed the recovery by kind of tamping down on that viral load. Dexamethasone has also been shown to have some positive effect. Dexamethasone is a heavy-duty steroid and is actually provided to the patient through an IV. What it does is it tamps down and limits an overreactive immune response for the body, which has caused adverse outcomes in the past. Now, there has been some talk about antibody cocktails and things like that. The issue with those antibody cocktails right now is that Regeneron has one and Eli Lilly has one. And in the case of both of them, they're approved under an emergency use authorization, but they don't have the full approval yet from the FDA. So that's why that's not standard of care yet. But if you're looking at what could you expect, this is what you would expect in terms of how to treat the coronavirus. In terms of the vaccine, there are 4 leading candidates right now, Pfizer and BioNTech, and Moderna are probably the furthest along. There have been some side effects, though, there. AstraZeneca actually paused its study at one point because of an adverse event. And Johnson & Johnson, unfortunately, had some bad news this morning about an adverse effect as well. The thing to remember about these studies, though, they're double blind, which means that Johnson & Johnson also reported earnings this morning. In their conference call, they were asked if this was even in a placebo patient or if this was a patient treated by the vaccine. And they just don't know yet because they're supposed to be blind to this, which is how you want to do the study. So if anything, this should give us more confidence in the approval process for these vaccines. It does seem like we are on track for some approvals by the end of the year, assuming that the side effects continue to be relatively minor. Importantly, the Johnson & Johnson drug has been shown to elicit positive response in terms of the memory T cells, which are the ones that really last long and provide more powerful immunity to the virus. So there's some good candidates out there. Johnson & Johnson, I would have said, has the best chance before today. It's a little bit behind, 2 to 3 weeks behind the others. But again, it did have a pause of the trials this morning. So we wait to see what will happen with that. Encouragingly, how does this affect the economy? Well, there are states that are opening up. There are states that remain closed. And as we go through the next few slides, I just impress upon you that these slides are happening in the context of a very uneven reopening. If you look at Texas, if you look at California, if you look at New York, 3 of the big population centers, those are still not really fully open. And so that's important to be cognizant of when we're looking at the outlook for growth and what potential we can have as potential states do reopen again. Because if New York reopens or California reopens, that could help to accelerate growth. Nationally, mobility, and this is the Dallas Fed's mobility index, and the Dallas Fed tracks mobility by basically tracking phones in aggregate. They don't track your exact device. They don't know who you are, but they do know the number of devices that are leaving home in a day, how far they're leaving home, and things like that. And there are a couple important call outs. The first is there's a clear V in terms of mobility, which paused in mid-June. This makes sense because this is when the second wave started. And then in about mid-August, this is when things started to reopen again. The second wave started to dissipate, and you have seen mobility tick up again. You also have schools reopening, you have churches reopening, you have people spending more time out of the house. And so you're seeing an increased mobility both nationally and in the state of Georgia over the last month and a half. The Dallas Fed also breaks it out between the cities and the countryside. And what we're seeing in rural areas is that things are almost back to normal. Their mobility is not down nearly as much as they are in cities, which again makes some sense. And but even in the rural areas, there was a bit of a pause there for a couple months as they digested the second wave. And then on a city by city basis, I don't think it's really that much of a surprise that Atlanta has reopened faster and more significantly than places like San Francisco or New York. The San Francisco piece is very interesting as well. After rebounding initially, it's basically been stagnant in terms of their reopening over the last 4 months. And I speculate as to one reason for that, and that is that a lot of San Francisco work is high tech, which means that you can do it remotely. And we've seen many announcements from various businesses in that area that they're going to be working from home for the foreseeable future. So we might continue to see the San Francisco mobility remain relatively muted, even while places like Atlanta continue to pick up steam in terms of people moving around. And this has important ramifications into actual spending. Bank of America tracks all this, and what we can see is that retail spending is actually up, and not up versus April and March, up versus last September, up versus last August, and up quite significantly so. And even more than that is if you look at the chart on the right, that chart that's labeled chart 11, you're seeing that the consumer segment that has really driven this recovery is the consumer segment earning less than $50,000 a year, which sounds a little bit counterintuitive because we're hearing all over the place, restaurants going bankrupt, retailers going bankrupt, and a lot of those workers make less than $50,000 a year. So one of the reasons that we've seen such an improvement in the spending habits in this group, I mean, you're seeing spending that's up 10 to 20% versus last year in this group, which is apparently out of work. One reason is that they're coming back to work, but the second reason, and perhaps the more significant one, is that there was a big benefit from the unemployment checks, which was $900 a week in many states, which is tapering off now, and also the $1,200 checks sent out by the government back in April. So there are a couple key elements that are supporting this recovery. And that's going to be a theme as we continue to talk about this, that the fiscal stimulus continues to have a positive impact on retail spending. And high earners, on the other hand, are not necessarily really driving the growth in retail spending, at least over the last 6 months. We also see, and this is not surprising, that online sales are up very significantly. This has tapered off a little bit, but it's still up quite significantly, even as brick and mortar retail sales have picked up. Now, brick and mortar sales haven't really been increasing much anyway over the last number of years. So modest declines like we're seeing now on a year-over-year basis are not really as surprising, but we're in the middle of a pandemic and we're in the middle of an era where people are buying a lot online. So you add all this up and people are spending a lot of money. One anecdote is Bed Bath & Beyond, the home goods retailer. They actually talked about it a couple weeks ago and said that they're set to report their first quarter of revenue growth in 8 quarters. Again, this is in the middle of a pandemic where people are worried about jobs, they're worried about getting out of the house, and they're spending more money at Bed Bath & Beyond than they did last year. I think a big caveat here is to remember that this level of spending may require more fiscal stimulus to support continued future growth. In terms of end markets, we're seeing daily spending at department stores that's relatively flat. Again, kind of like Bed Bath & Beyond. This is a place where it should be very pressured. I mean, people were spending less money at department stores for the last 30 years, and now they're spending the same amount as they did last year. And so that's a healthy sign. Even though it's flat, it's healthy. The middle chart is airline spending. That's coming back, but it's coming back slowly. And then the final chart there is home improvement stores. And this is probably the finest story from everything that we've seen. And again, it makes intuitive sense. People are spending more time at the home. They want to renovate their homes. But to be this steady, 20% month after month, is pretty impressive, and one of the most impressive sustained trends we've seen throughout this pandemic. This last chart, and again, Luke posted the slides in the group chat there, but this shows how different states spend money, and I won't spend too much time on this other than to say, if you look at the state of Georgia, which I think is apropos to many of our audience here, spending at restaurants and bars is up 3% over last year. So again, that's counter to what many would assume. And it's just a proof point that people are getting out of the house, they're spending money. They may not be working in an office, but they're getting out of the house to spend money. And we're seeing that happen, especially in Georgia, but even in other states as well. So they're spending money in retail. People are also spending money on the home market. Home sales are up almost 20% compared to last year. And this is, reasons for this. You got low mortgage rates. You have actually people with increased savings, and we'll talk a little bit more about that. But also just rising demand for moves out of the cities. We're starting to see some anecdotes from that. And buyers are so eager that they're paying very close to list price. That top chart shows the price of the final sale relative to where the house was listed. So typically, I mean, if this was last year, if you listed a house for $100,000, you might expect to sell it for $98,500, which would still be fairly good. This year, if you list a house for $100,000, you would expect to sell it for closer to $99,500. So what this means is that this is a seller's market. Sellers have the negotiating power because buyers have an extremely strong desire to purchase a home. All this adds up to higher sales prices and home prices are going higher by almost 15% compared to last year. And I think this is an important distinction to make with the recession of 2008, where home prices obviously collapsed. So a very different type of environment catalyzed by increased consumer spending in both retail and home sales. And one of the reasons for this is that savings accounts are up. And now, again, the inevitable question is, how are savings accounts up when we're in the middle of a recession? And JP Morgan actually explained this back in middle of September, and they said, we're seeing the savings rate increase because while we have seen spending go down, we've actually seen discretionary income be flat or even up. So this is an atypical recession, and it's resulting in consumers that are more flush with cash that can afford to spend. We actually had JP Morgan report earnings this morning, and their deposits were up 28% compared to last year. That's 6 to 7 years of growth, and they did it in 1 year. And so consumers have cash to spend. In fact, one thing that JP Morgan also mentioned is that their credit card business actually isn't doing as well because people aren't carrying as big balances. So they're not paying interest on those extra balances. And so JP Morgan actually saw a little bit of a hiccup on that, but card delinquencies have barely ticked up at all. And there's plenty of savings in the savings accounts of the average American. We've seen employment improve. So these are new claims for jobless benefits. Again, there was a little bit of a stall out there in the middle of June to beginning of August, and then it picked up again in terms of the decline. We'd like to see that continue to pick up. But the big story here is how fast we've come back. We've already recovered 49% of the jobs that we lost, which is pretty historic in terms of the rebound. We spiked up to unemployment rates of over 14%, and we've already fallen back down to 7.9%. If you compare that pace of recovery to the recovery in 2008, it's been lightning fast. So in 2020 here, we've recovered 49% of the jobs in about 4 or 5 months. In 2008, we recovered 49% of the jobs in almost 5 years, in about 4 to 5 years. So it's about 10 times as fast in terms of the recovery as we had in 2008. And a lot of that's catalyzed by things like the Federal Reserve lowering interest rates very aggressively, and obviously the stimulus on the fiscal side. And the reason they've spent so much money on the fiscal side is because they really want to avoid this gap that we saw in subsequent to 2008. So if you look at the green line there on this chart, we see the participation rate. And generally, we don't like to see a participation rate below that black line because what it means is that people are kind of giving up looking for work. And if you haven't worked for 2 to 3 years, you start to lose skills. And when you start to lose skills, you become less employable, and it becomes more difficult for you to find a job and actually contribute. So that's why the speed of the recovery is important. And we can see this even clearer on this chart here. Again, you want to stay on that red line or even above that red line. There's going to be some natural decline as the population ages and people retire. But you don't want to stay too far below that red line for too long, because you'll have a systemic problem with a recovery like we did between 2010 and 2018. And you can already see we're coming back pretty quickly on that participation rate, but we need that to continue, which is why the Federal Reserve continues to be aggressive in its quantitative easing programs. Currently, in fact, we might actually reach, if you straight line this current GDP estimate, we might actually hit positive GDP by the February or March timeframe, which again would be an extremely rapid recovery by historical standards, and would certainly speak well to the Fed's policy, to the government's policy in pulling us out of this as rapidly as can be done. Tom will talk a little bit more about that stimulus here as we move to inflation.
We're going to talk a lot about the Fed this afternoon, and the first point we want to talk about is the Fed's ability to predict what's going to happen. And the Cleveland Fed has actually been fairly accurate in predicting the route that inflation has taken through the year. So you can see with the blue line, this is the Cleveland Fed's estimate of inflation versus the actual recovery, which is the black line of core inflation. As you can see, they're pretty on the money, though they tend to be a little bit behind in terms of their predictions. But we're starting to see a tick up in inflation, which is very positive. And one of the things the Fed has been extremely transparent about is their want to spur inflation and, in fact, exceed what their previous target was, which was 2% inflation. They want to run inflation hot for an undetermined period of time in order to get us back on track. We've basically been sub 2% for years now. And so their new mandate is saying we want to run inflation above 2% to an undetermined level in order to get things back on track. And the amount of money that they pumped into the system should facilitate that, though we haven't seen a print above 2% in quite some time. So the next slide is actually a little bit of a blight on the Fed, which is to say that they have been super inaccurate in their predictions for pretty much the rest of the market. As you can see, the numbers on the left-hand side here, their predictions for the change in GDP versus the actual change in GDP. So, for example, in June they were predicting down 6.5%, and it actually was down 3.7%. And so the Fed, which claims to be, some of the most accomplished economists in the world, are having a tough time with this market and with this pandemic. And, obviously it's unprecedented, but right now they're basically, to use an example, they're like a weatherman. They may be able to tell you what temperature it is tomorrow, but they have no idea if it's going to rain. And so that's really where we are in terms of the Fed right now. And so they're behind on their forecast. They're behind on how much they think the recovery is going to, or how quickly it's recovered. And I think we're going to continue to see that. And we'll talk a little bit more about that later on further Fed slides. But they're just not able to quantify this thing. And I think that really bodes, well for what Ben's previously talked about, which is we've seen a recovery that's faster and stronger than even we would have imagined.
Thanks, Tom. And it's not just the Fed. I mean, Wall Street analysts as well. So typically Wall Street analysts, again, very good at predicting those small moves. You'll see them be off by 0.2% on a revenue estimate, and that'll be a big beat or a big miss. And this is what we saw last year. I mean, last year in Q3, Wall Street analysts pretty much nailed it, getting the revenue for the entire S&P 500 off by just 0.2% when the companies actually reported. This time around, they're off by 4%. So you're talking about a 20x difference in terms of the forecasting accuracy for Wall Street analysts. And these are smart guys. They're very good with the models, and they generally predict very close to what ends up happening, but not so in this reporting period. And one great example of that is Nike. Nike, Wall Street was looking for a sales number of $9.1 billion. Nike came out with a $10.59 billion number just a few weeks ago. That's a beat of 16% and the biggest beat since 2011. And that's on revenue. This is something that Wall Street analysts nail to the tune of 0.2%. and they missed that estimate by 16% to the upside. Importantly, the Nike CEO was really positive on the call, saying that he expects a lot of this strength to continue and saying that we can thrive in this environment and even in the midst of this disruption. Furthermore, it's not just Nike, because CEO confidence all over is actually fairly strong. You can actually see that CEO confidence is higher than at any time since before 2017 today, in the middle of a pandemic, in the middle of 7.9% unemployment, and in the middle of this political maelstrom that we have right now. And I think that's a great sign when you're thinking about people making plans to hire people, when you're thinking about CEO plans to invest in capital and spend money on large-scale investments. And also when you're thinking about people making decisions to grow and make acquisitions. You can actually see that in the third quarter, we actually saw higher deal volume than any quarter since the second quarter of 2019. And it was the best third quarter for M&A activity since the third quarter of 2015, 5 years ago. Again, in the middle of a recession. So there are a lot of things that are atypical about this. One was the catalyst, the pandemic. Another one was the incredibly aggressive fiscal and monetary response. And what we're seeing is that CEOs on a macro level are actually feel fairly good about where they are. Jamie Dimon, the CEO of JP Morgan Chase, actually talked about it this morning on the conference call. And he said, there's this guarded optimism among CEOs in the country. And Andrew, who can talk a little bit more about this in the next couple of slides.
Yeah, thank you, Ben. One of the things we like to look at a lot, and if you're a regular listener to these macro calls or the morning calls that we do every day at 8:30, is really what actual business participants are saying. So the next two slides cover commentary featured in ISM reports, both on the manufacturing side as well as the service sides. And these are kind of their report on business, so to speak, from September 2020. So obviously, we've talked a lot about the positive trajectory of this, but I think it's important to kind of take a little bit of a pause and recognize that, things are not back. They're not back to normal. And there's no area in which we see that more clearly displayed probably than the entertainment sector of the economy. And when we think about entertainment, at least traditionally speaking, a lot of times we think about things as simple as going to the movies. So we see here that the industry is facing a bleak outlook as it relates to movies. And they are very, very concerned about that. And they expect that some of these closings, some of these cancellations, the pullback in Hollywood studio production is going to mean that some of these industries and these businesses are going to not only operate at a loss in 2020, which seems pretty obvious at this point, I think we would all agree, but also into 2021. Another area in which we're seeing some real concern is on the education side. We're seeing enrollment down at public universities as well as private colleges. And a big impact there that can especially impact fixed income and some bonds issued by state and municipalities that are associated with university housing is that they're seeing a real hit to the footprint of students living on campus. Public universities seeing as much as a 25% decrease in students living in university-provided housing. So there are some sectors that are going to continue to be a long slog out. I think maybe at surface level, we think about restaurants, we think about things like that. But even industries and institutions like education are still going to feel the pain of this for a prolonged period. But as we've said kind of along the way, also lots of good things happening right now. As we look at the machinery industry, we're starting to see outlook that is generally positive. We can see one quote here: our customer order intake is increasing significantly for deliveries in the first half of 2021. I think what's encouraging about that is if they're increasing orders, they're not simply trying to get back to where they were from an equipment and machine standpoint. They're actually trying to continue to make progress on an economy that really was humming on all cylinders prior to this point. We are seeing some raw material shortages, specifically in wood, which is really driving costs up, and I think probably having a little bit of an impact on housing prices, which we touched on earlier. And in healthcare, when we talk about healthcare in the year 2020, we pretty much talk about emergency room capacity, how many beds are available, what's going on with COVID testing, things like that. And somewhat, under the radar is the fact that elective procedures remain at near historic levels. People are still having health procedures done. We're also seeing, just from the retail side, which we touched on earlier, businesses come back solidly since mid-July with a strong August and September. We talk about this stuff a lot on our morning calls, and we talk about the challenge of having to use data. Sometimes it's a little bit dated, whether it's unemployment data, you name it. We only get certain data points every so often. But we're seeing that this is not only a strong rebound since mid-July, but into August, into September. And based on where we are, we would probably draw that trend out and hypothesize that moving into October, we're continuing to see some strength.
Yeah, and on the housing side, again, KB home orders up 27%, Lennar up 16%. Again, analysts were looking for negative 6%. So the important thing here is not only the improvement, but also how sustained it is. So we saw the comment from the Nike CEO. We also see the comment from the Lennar CEO saying that we expect home sales to remain strong for the foreseeable future. And then Costco, absolutely outstanding results, up 16.7% in September, growth driven by hardware and consumer electronics. And again, this is not compared to March and April. This is compared to the level of sales last year. So really bear that in mind. This is good growth, and it looks like retail might have a pretty solid quarter. And part of that's due to the Fed and the money printing that's gone on there. And Tom, you can talk a little bit about this.
Yeah, thanks, Ben. So this is a chart of the Fed's balance sheet, and you can see they learned a lot of things from 2009, which is essentially that if they're super accommodative and the credit markets don't freeze, there's a lot less damage to the economy in the long term. And so what we saw this year was the Fed basically ramp up and have unprecedented spending as soon as the pandemic hit. And we're in an unusual spot. And Andrew says, this is not technically a normal situation. And the Fed's accommodative practices are not typical. In fact, they're unprecedented. But I think what we've seen, and the V-shaped recovery can really be traced to the fact that they moved early, moved often, and made sure that the financial markets, the housing markets, didn't freeze up. We didn't have, mass defaults like we had last time. We had just plenty of cash on hand and pumping into the market in order to get us through this, even if it was only a 3-month period where everything was shut down. And that being said, you can see here the Treasury has accumulated an unbelievable amount of money. We've talked a lot in our morning calls over the last couple of weeks about further stimulus, and the money is there. It's ready to go. It's almost $5 trillion just sitting on the Treasury's balance sheets, waiting for a deal to come through. And so it's locked and loaded, and there's plenty more stimulus to come. The stagnation that's happening in DC is really holding up a lot of money to hit the market, which could even be more beneficial going forward.
Indeed. And so when you put it all together, there are really 3 big takeaways from this. And that is that employment has improved faster than expected. There are some concerns about the labor force participation rate. That's why policy is being as accommodative as it is, because we want people to get back to work and not lose those skills. And we are seeing growth returning if you're looking at consumer spending, if we're looking at household spending, and even if you're looking at merger and acquisition activity on the corporate side. Growth is coming back. And that's due in part to policy remaining highly accommodative, continued low interest rates, continue to support these acquisitions and continue to support faster growth, as well as that federal government spending, which again remains pending. But with that, I'll hand it back to Luke for the next poll.
Thanks, Ben. Yeah, before we get into a history of Barstool Sports here, we are going to do a second poll, and this one's pretty simple. Should be able to see on your screen here. Which S&P 500 sector has seen the best performance year to date? We got consumer staples, industrials, financials, information technology, energy, and healthcare as options. All righty. Looks like information technology is the winner with 61%, closely followed by consumer staples. Ben, back to you.
Thanks, Luke. So Dave Portnoy, I'm sure some of you have heard of him. He was one of the founding members of Barstool Sports, really a sports guy. But when sports kind of got deferred, I guess you could say, in the spring. He said, I need something to do. And so he took up day trading, and he had some pretty bad weakness early on, but gradually started to do better and better, which only made him more and more iconoclastic and bold. And he said many times, and it really became his mantra, that stocks only go up. Of course, stocks don't always go up. He found that out in September. But nevertheless, the optimism was a reminder and a balance to some of the pessimism that we saw among the talking heads in the media and also the financial media. What is true is that growth continues to outperform value. I'm not going to spend a ton of time on this because we've talked about this a lot in previous calls, but suffice it to say, nothing has really changed this quarter. Growth again outperformed value by really kind of historic proportions for a single quarter, especially when you combine that onto what's happened year to date, talking about 32% outperformance year to date from growth stocks. Historically, again, value stocks have performed well. I mean, these are value stocks, the companies that are slower growth, they pay a dividend, they trade at relatively low multiples. Think the classic Ben Graham stocks. But those have not done so well because they also have some debt. They have some debt and they have some low growth. And in this environment, people are looking to say what company is going to be around in 10 years. And if you have a lot of debt, and if you're not growing very fast and you're at risk for being disintermediated or succumb to some sort of innovator's dilemma, you do have some risk about you. And that's really helped to explain some of the disparity between the returns that we've seen year to date. Another thing that hasn't really changed much is that the U.S. continues to be the second best performing stock market in the world. The other ones have moved around a little bit, but the order by and large remains the same. So the U.S. is actually posting a positive return year to date. So I think that's something that is important to remember. And if you look at the S&P 500, the S&P 500 is up 5.6%. Now, this is an important one to look at as well, because like the difference between value and growth, we've seen a remarkable difference between the Dow Jones and the NASDAQ and even the S&P 500. The S&P 500 tracks 500 of the largest companies in the United States. The Dow Jones tracks 30 of the kind of more legacy companies in the United States. And so again, it makes sense that the Dow might underperform the S&P 500 because we've seen that value has underperformed growth. So that's kind of where we stand right now. And then the NASDAQ is up over 25% on a year-to-date basis. It has a lot of those tech stocks. So the NASDAQ is the clear outperformer there. And for those of you who answered technology, you are right. So the ayes have it. Technology and industrial stocks have led the market year to date. Financials and energy lag. And maybe the question is, well, I thought retail was doing really well. Why isn't consumer discretionary higher? And the answer is consumer discretionary was the second best performer in the third quarter, but it had so far to come back that overall the consumer discretionary stocks are still kind of in the middle of the pack on a year-to-date basis. As we look forward, one of the things that we want to gauge is the current sentiment in the market. And one of the ways to track that is by looking at the VIX index. VIX index is a measure of how really, it's often dubbed the fear index because it's how much people will pay for protection. So if you live in a flood zone, you'll pay more for flood insurance than if you don't live in a flood zone. And so what we see is in March, people paid a lot for protection, for downside protection. And we've continued to see that that insurance premium, for lack of a better term, has continued to erode, which is actually a positive because it means that people are becoming a little bit less nervous and things are becoming a little bit more stable. So we look for that to continue, and it's notable that the VIX continues to make lower highs, even though there is spikes, and there'll probably continue to be spikes. These spikes are going to lower levels, which means we're moving in the right direction. This coincides with the move we've seen in gold. Gold really reached a peak of $2,075 per ounce really looked fairly similar to what we saw in 2011, actually, when the United States AAA credit rating got downgraded by Standard & Poor's. But the reason it moved up so far this time was because the Federal Reserve was extremely aggressive. It was talking about moving its inflation target from a specific 2% to an average of 2%, which means inflation could drift above 2% at some points. And so what we've seen is as the economy has started to come back and as that fear has tapered down a little bit, we've also seen gold pull a little bit back from its highs as things have begun to normalize a little bit more. Similar thing can be seen in interest rates, where we did see that interest rates have backed off a little bit as well. Tom, can you talk a little bit more about that?
Yeah, thanks, Ben. So what we're looking at here is a chart of the 10-year Treasury, which is essentially the lodestar for people who follow interest rates, like bond traders like myself. And we saw it fall precipitously in February, and that was more fear-driven. And then it popped in March, which is more the market melting down. And you can see when the Fed stepped in to settle markets, it came right back down in March. And we basically tailed off since then. But with the tick up in inflation and with the positivity starting to hear whispers in the market, we're starting to see the 10-year tick back up again. And I think that's driven by a couple of things. I think, a smooth election, assuming it's going to have a quick changing of hands and a smooth changing of hands, I think we'll continue to push interest rates up. And that's just a marker of positivity. When the markets were really bad, when people were locked down all the way through August, I mean, we basically were in a full fear factor mode. Gold was, at an all-time high. People were filing into what they would call risk-off securities, and treasuries would be really the gold standard there, no pun intended. But we're starting to see opportunities. We're starting to see a little bit of a release valve on interest rates and bonds to a lesser extent. And here we have the mortgage rates. Also, my screen is getting blocked a little bit by my own face. But you can see the mortgage rates are near all-time lows as well. And that's really what the Fed wants. They learned in 2009, like we talked about earlier, that the housing market drives the economy. And so they want people to be able to buy houses, improve houses, sell houses, because that really makes the economy go around. And so that's really what they want to see. And it really helps the economy when we have mortgage rates at these levels. So here we've got, so this is a chart of the spread between junk bonds and treasuries. And so basically what we've seen here is the amount of money you get paid to own a junk bond versus a treasury. And we've seen some widening of the spreads there. You can see towards the height of the pandemic, we saw junk bonds sell off, and that, like we talked about with treasuries, people were exiting, things would be risky, and junk bonds would traditionally be risky. And we're starting to see a little bit more weakness there. We're seeing a tick up there. And where we would find opportunity there is we're looking at bonds in that space right now. And to give you an example of a bond we bought recently, Owens & Minor is a small regional medical supply company based in Virginia. And for a long time, they've been sort of a secular decline story. They aren't doing as well as they have in years past. They're running up a little bit of debt on the balance sheets, but COVID hits and suddenly they're just flush with cash. Their stock price is up. They issued new stock around $24 to fill their coffers with cash. And suddenly a bond that's rated B-, which is about as low as you can get without being rated C, which is basically no touching bond levels. You don't want anything in that area. They're suddenly flush with cash, and the amount of debt that they have seems pretty reasonable considering they have a positive environment to operate in. And so we switch slides here. But that's something where we'd be looking in that space. We think, hey, we can get 4.5%, 5% on a bond that's only 3 or 4 years in duration, which is 4 or 5 times what you would get on a muni, and 1,000% of what you get on a treasury. But looking into the macro environment for that bond, looking into the balance sheet for that bond, we can see that, hey, maybe this bond really needs to be re-rated. And a lot of these junk bonds don't get nearly the number of eyeballs from Moody's and Fitch and S&P that other bonds do, like things like AT&T, which has the most indebted company in the world. They just rubber stamp that, say it's BBB, and move on. Whereas these bonds might get looked at every 3 or 4 years. And so that's what we're looking for, and we're starting to find some value there. So I'm starting to find some companies that may have been thrown by the wayside that we can really pick up some extra yield and some extra juice for portfolios in an environment where, you know, everyone's saying the bond market is valueless.
Thanks. And part of what we do, both on the bond side and on equities, is really look at sentiment and really try to analyze and understand where sentiment is from a very measurable perspective. And one of the ways that you can do that is with this Goldman Sachs risk appetite indicator. And that's that light blue line. And what you're seeing is that risk appetite is neither excessively good or excessively bad right now. It's kind of finely balanced. And you can actually see that in this second chart here, which is from Merrill Lynch. And things have become a little bit more aggressive, especially if you look at hedge funds over the past 3 months since we last spoke. But it's not aggressively so. I mean, people are still relatively nervous, kind of between that neutral and nervous level. And they've started to deploy a little bit more capital, but people are not yet comfortable. And actually that presents opportunity because if you can get it on that ups, if you're basically, you want to be there before the other people are. And so you're starting to see hedge funds become more aggressive, but long only funds are still fairly negative, only 29%, 29th percentile in terms of positivity on the economy and on the markets. And this is in spite of this very stunning GDP number, which we're probably going to get to be close to 30% here in Q3. We saw a historically bad number in Q2, probably see a historically good number in Q3. So you put all this together, and at the end of the day, on the equities, we're seeing companies with growth prospects continue to lead. And we do expect, as we've seen already, some favorable upside revisions to earnings estimates. On the fixed income side, with interest rates so low, we're actually seeing more opportunities in bond structure, things like convertibles, things like the owns and minor bonds that Tom talked about. On the consumer spending side, it is elevated, but the savings levels are up. So I would not argue that it's excessive. And probably the most positive area right now is business investment. We have actually pretty solid CEO confidence. People are actually making these big investment decisions. And we're also seeing increased merger and acquisition activity. So there are definitely reasons to be positive, and there are reasons to think that this economic recovery will continue. Luke, you can take it away for the next poll.
Awesome. So quick disclaimer before this poll, again, everything is anonymous. So if you want to abstain from this one, you can, but I think it'll be pretty interesting. We're going to ask the crowd two very different questions. Who do you think will win the 2020 presidential election, and who will you vote for in the 2020 presidential election? We'll allow a few extra minutes for those of you who are undecided on number two. And we've got 53% for a Biden win and 87% voting for Donald Trump. Interesting.
All right, thanks, Luke. It's probably a leading slide to have when I put the income tax on the slide. But I'll actually hand it off to Andrew here to talk a little bit about where we stand on the political front, but then really dive into what the taxes are going to look like here over the next period or so.
Excellent. Thank you, Ben. Thank you, Luke. Interesting poll there. I think President Trump would probably like that poll more than the ones he's seeing. He says that he's seeing the real polls and he's looking strong, but every public poll is certainly heading away from the president, as you can see here. This is the Real Clear Politics polling average, showing Trump at about a 10-point deficit, which is certainly very pronounced. But it does raise the question, as I did facetiously a moment ago, how legitimate the polls are. CNBC spoke with a corporate restructuring attorney, does a lot of work on Wall Street, and they published an article today saying, quote, "After the last election, and there are a lot of people in this camp on Wall Street, no one can trust the polls." So that's the view of many. I think that's the view of a lot of people. There's lots of things that we could probably question about the polling practice. But if you think there's any truth to what's happening in the polls, then it's probably not stacking up too favorably for Trump at this point. Now, obviously, the popular vote does not decide who the president is. We've got the Electoral College to deal with. There's swing states. There's all kinds of factors involved. But things are trending away from Trump. You can see it on the prediction markets, which you can see here, Trump at a pretty significant disadvantage at this point. 538, which is Nate Silver's site, that does pretty consistent updates on their own proprietary model that's based on weighting of different polls that they think are better or worse, and demographics, all kinds of stuff. It wasn't that long ago, maybe a month or 6 weeks ago, that they gave Trump a 30% chance of winning. He fell to 14% as recently as yesterday. Today, he's actually at 13%. So pretty long shots. It's worth noting that 538 had Trump at a 30% chance of winning going into 2016. But this is going to continue to create some uncertainty, and I'll talk a little bit more about the prolonged effect of that uncertainty. But I think what would be prudent at this point, given that we have polls showing things going a certain way, is to really take a look at what an economy under Joe Biden would look like through the lens of taxes, incentives, things like that. And to do that, we've got Melissa Visible coming on to chat. Melissa is our financial planner. She's been with us about 2.5 years. I know a lot of you have gotten a chance to work with her closely. We highly recommend that you take advantage of that. If you have a question about how to get in touch with her and what she's able to do, whether it's a project or a huge financial plan, anything like that, please reach out to us or reach out to her directly. But Melissa is going to walk us through what the Biden economic program would look like if he is president.
Awesome. Thank you for that intro, Andrew. Like you said, I'm going to discuss the Biden tax plan, and most of the data that I'm using today summarizes an article that was written by the Committee for a Responsible Federal Budget. And there are 4 estimators that conducted research on these proposals, and that's Tax Policy Center, Penn Wharton Budget Model, Tax Foundation, and American Enterprise Institute. And so just a reminder, these are proposals, and we're just going to be hitting on some of the highlights. Also know that changes could be made between now and when this could be passed. But if you have any questions, please utilize our chat or contact us. So this first slide, the tax plan philosophy. We'll get into the numbers in a bit, but obviously raising revenue is a goal, while having higher taxes concentrated on the wealthy. We'll also take a look at some of the tax incentives that the proposal has to offer. And overall, this plan could moderately slow the pace of economic growth and possibly labor supply by discouraging work and capital accumulation. So let's talk about the impact on revenue. It's projected to raise about $3.5 trillion over the next 10 years. About $1.5 trillion coming from corporations, about $1 trillion coming from high earners, and we're talking about 400,000 plus household. And then about $1 trillion coming from payroll taxes on high earners, and we'll talk a little bit more about that in a minute. So I really want to hit on some of the high points of the proposal, starting with the corporate taxes. So the proposal is to increase this to 28% from the now 21%. This isn't as high as the pre-2017 tax reform rates, but this is where you start to see that indirect tax consequence for taxpayers. The next thing they want to do is repeal the 2017 tax reform rates for taxable incomes above $400,000. So they want to revert back to the old rate, which was 39.6%, instead of using the current rates, which would be about between 32 and 35. They also want to make this 39.6% capital gains rate for those making over $1 million in income. So it's essentially adding an extra capital gains tax bracket. The next point is either eliminating step up in basis or making a death realization event. And a change like this really could shake up some estate and gifting plans. With no step up for the heir, when they go to sell the assets that they inherited, they could likely incur a hefty tax bill. And another option would be imposing that death realization event, meaning that the decedent would be taxed on any unrealized gains. So if this passes, I think we'll start to see people not holding on to those low basis assets. That could either cause a tax impact for them at death, or it could be a larger tax implication for their heirs. Another note to add here is that they are also planning on cutting the estate exemption in half to about a little over 5 million from the current 11 million. Next point that they'd like to do is a full 12.4% Social Security tax on wage earnings above 400,000. So just to give you a little bit of background on this, there's a graph on the right to kind of show, illustrate this a little bit more. But currently earnings above the annual taxable maximum of around 137,000 for 2020 are not subject to payroll tax. So if you make $140,000, everything up to 137 will be subject to Social Security, but that gap in between won't be. But with this proposal, they would continue this until you reach a $400,000 threshold. Now, at this point, then you're going to incur that tax again, but no additional benefits. So it creates this donut hole. And over time, that donut hole disappears and all earnings are subject to full payroll taxes, half coming from you and half coming from the employer. And the reason why you see this disappearance is because that 137 is going to continue to grow with average wage growth as it is under current law, while the 400,000 will remain fixed. And so I think we'll start to see a lot more with Social Security. It may not be in the next presidential term, but there's been more and more discussion on the current state of Social Security benefits, and this is something I'm continuing to monitor and provide updates on. Then the last point I want to hit on this slide is the elimination of tax preferences for real estate. And just to name a couple is deferring capital gains for like-kind exchanges. These are also known as 1031 exchanges, and eliminating accelerated depreciation on rental housing. And then I also want to discuss some of the high points on the credits and incentives that have been proposed. So the first one is a $5,000 tax credit for informal caregivers. And I think we're seeing this because of the cost of healthcare increasing, and along with people living longer, and people are starting to rely on their family members more to take care of them because of these high costs. Another credit is the expansion of the child independent care credit. And they want to expand this by making it refundable for those with no tax liability, increasing the maximum allowable expenses from $3,000 to $8,000. That's for one single dependent. And then for multiple, it'd be up to $16,000. And then they want to increase the reimbursement percentage that you get from those allowable expenses from about 25 to 30 to 50%. So this would increase the maximum value of the credit from $2,100 to $8,000. There's also been a lot of talk about student loans, especially with COVID and people losing jobs. They're not as simple as some may assume. There are different repayment plans that you have to evaluate based on your job status and other financial circumstances. So if you're on an income-based repayment plan, the remaining loan balance will be forgiven after a certain amount of years, usually 20 to 25 years. So this is great in a way, but still detrimental because that forgiveness amount, that remaining amount at the end of the 20, 25 years is taxable income, meaning a borrower has to plan for the large tax bill that they're going to get. So they want to get rid of this and make it non-taxable. They also want to restore the energy investment tax credit, and this provides an incentive for alternative fuel sources, along with restoring that electric vehicle tax credit, which has a max of $7,500 for purchasing an electric vehicle. And the last point I want to hit on this slide is the first-time home buyers credit of $15,000. So this used to be a credit back in 2008 to encourage home buying. Now this would come back and it would continue to encourage home buying, but it would be more for the reason of those who don't have enough for a down payment. And this is largely due to the student loans. So I think this credit would definitely be a game changer for those first-time home buyers and the housing market as a whole. So overall, those in the bottom 4 quintiles will see an increase of about 0.2 to 0.6% of taxes and after-tax income. And those in the top 1/5 will see an increase of about 2.3 to 5.7% in taxes. You can tell from this chart that a large chunk of that is coming from the top 1% of taxpayers. So just to reiterate, there are no direct taxes on households making less than $400,000, but like I said, you'll see an indirect effect of raising corporate taxes. So this pretty much concludes the high points from the Biden tax plan. Like I said, things could definitely change between now and when this could go into effect if he becomes the next president, but I'll continue monitoring this plan as the election season continues. You'll be able to find some of these updates and more information on our website and under our blog posts.
Thanks, Melissa. Really appreciate it. And a great plug for the website. We recently reworked the website. Luke Burton and a number of other folks worked really hard on it. But trying to make our commentary more accessible and easier to read. So if you get a chance to check out the website, you can read on that. And really, I think what's important here is we get the question all the time from clients, what's going to happen to the economy, who's best? And as you can see here, this chart shows U.S. equity returns on an annualized basis during various presidents. And there's really no consistent pattern in terms of, Democrats always drive the market up. Republicans always drive the market up. Incumbents always drive the market up. Challengers always drive the market up. There's really not a consistent pattern here. The only pattern that you could really discern from this, if you look at recent presidents, is really the fact that the market trends upward, which I don't think is a surprise to anyone on this call. So there's no real clear case to be made for one necessarily being better for the other. And the other thing we say so often is that the economy is not the stock market, and the economy is much bigger than something that one president can control. That's why people, I think, are so hesitant to say that the economy is doing well, because to do so would, at a point like now, be giving a little bit of credit to a previous Democratic regime. And if you're a Republican, you don't want to do that. And if you're a Democrat, you certainly don't want to say that maybe Trump has things heading in the right direction. So it's so polarized, just like everything else in the world right now, that nobody really wants to talk about it. In general, a pro to Trump staying in office would be that typically under Republicans, we see a little bit less regulation. That seems to be a little bit business friendly and sometimes helps CEO confidence, things like that. But the Democrats, there's a case to be made there that there could be more stimulus, and that could really juice the economy. What's interesting, and I think what people really need to be mindful of, is there's going to be continued volatility, not only up until election day, but thereafter. I think we're really probably setting ourselves up for a little bit of a contested result. Noteworthy, I think, is the contested result back in 2000 saw the month of November be the single worst year for the stock market in the U.S. When that was so highly contested. So the market was actually down 8% in November of 2000. So something to keep an eye on there. Goldman Sachs has actually been calling clients. I saw a report today and really kind of warning that this could drag on for a little bit longer. That's going to create uncertainty. It's going to create volatility. UBS analysts actually weighed in and said investors initially feared a blue wave, but a delayed or contested election is even more unsettling. So I guess this is just kind of our friendly way of saying buckle up. I don't think we're going to wake up on Wednesday morning after the election and concretely know what the reality is, what the tax rates are going to be, who won, and see exactly what direction the economy is going to go. But even if we do wake up and we know exactly who it's going to be, that's not necessarily going to be a victory bell or a sign of doom, regardless of who wins.
Thanks, Andrew. We're going to finish it off here with one last poll, and then Ben will take our conclusion. This is a very simple one, A or B. Are you better off or worse off than you were 4 years ago? Alrighty, closing the polling here. Wow. Congratulations, everyone. No one chose worse. So I guess that's encouraging. Awesome. Ben, back to you.
That's a good way to finish it off, because the next couple slides, show that people are a little bit anxious now. And I think it's something to keep in context about where you feel versus where you were 4 years ago. And the blue line here logs Google searches for anxiety, all-time highs. Similarly, the red line logs Google searches for the term therapist. Again, all-time highs. So there's definitely some fear, anxiety, worry in the market. That's, the title of our presentation today is Why Worry? There's certainly reasons to, but if you can define things and actually look at what's going on and really take a step back and look where you are, and maybe it's not all bad. And again, you actually agree with the majority of the American population. 56% of people think that they're better off now than they were 4 years ago. Similarly, you're seeing here that the wealth gap actually decreased, and this only goes through 2019, unfortunately. This is a Federal Reserve survey that actually came out 3 weeks ago. But the bottom 40% in terms of net worth actually increased in net worth by 40%, by 37 to 40% over the last 3 years. And the median net worth of the people in the 80th to the 100th percentile, that actually declined. So we actually saw a little bit of the wealth gap decline over the last 3 years, as there was some more equity in the market. And but it's not just people on the street who are a little bit pessimistic. It's, I'm going to throw the Fed under the bus again. They're an easy target, but the chairman of the Federal Reserve, Jay Powell, said just in a speech a few days ago that he thinks basically the unemployment rate's more like 11% right now. He said this a day after the unemployment rate posted a 7.9% print. And it's this kind of looking at the glass half empty that I think is just kind of pervasive. And I think that there's definitely more to it than just looking at things half empty. And so leave you with four things here. First of all, the economy has come back faster than the consensus predicted. CEO confidence, commentary, things like that say that this economic recovery will continue. We talked about sentiment in equities is still a little bit nervous. This supports equity prices going forward. And then in fixed income, although there are fewer opportunities in buying fixed income bonds that yield 50 basis points, there are actually opportunities that can be found in the structure, as Tom mentioned. And finally, on the taxes and the politics front, we like to find shorthands of ways to handicap what's going to happen. But really, I'd encourage you to follow the facts, understand how the potential changes in the tax code could impact certain behaviors, could impact certain investments, could impact your own finances. But in general, as Andrew encourages us, focus on actually what's the main story here. And the main story is that the economic rebound has happened and it is happening. And we might need some more stimulus to continue that to happen. But right now, things look great in some pockets of the economy, and things look they're coming back slower in other pockets. But in general, a much more optimistic note than when we first did this Zoom macro presentation 6 months ago. Luke, take us home. And actually, there might be some questions in the queue, so we can.
Yeah, we do have one question, and it came up during the section on interest rates. So I'm going to pitch this one to Tom Russell, our fixed income extraordinaire. So Tom, the question is, how do you invest in fixed income with interest rates being so low?
The way I would explain it to people is that investing in fixed income is sort of like whack-a-mole, in the sense that there's always going to be something that presents value. The question is, how quickly can you get to it? And to give you a good example, earlier this summer, we found a very unusual niche in the bond market, which is ultra short-term convertible preferred stock. And so we found this ticker, it's SWT, Sierra Whiskey Tango. And what it is it's a preferred stock, which is essentially like a baby bond that is, a debt piece for Stanley Black & Decker. And it matures in 2021, and it pays a 5% coupon on a quarterly basis. And the value of it can move up and down because at a certain price, they're able to convert that into Stanley Black & Decker stock. And so what had happened was these preferreds have become dislocated from the stock itself. Stanley Black & Decker has done very well, with the retail area doing so well, people going out to Home Depot and improving their houses. Stanley Black & Decker is a pretty good stock to be owning right now. But we found these preferreds that mature in 2021, and they were trading at an 8% yield. And so, we looked at the balance sheets and we looked at the available options inside of portfolios, and we thought this is a really good option to take a little bit of risk. You're getting a monster outsized return in terms of yield, and your duration is very low. Because we always say if we're going to take credit risk, we don't want to take duration risk too. You want to do one or the other. You want your really long bonds to be very, very clean, and you want your really unclean bonds to be very, very short. And so at the peak of the pandemic, when interest rates, the 10-year was at 55 basis points, we could find a 2-year bond stand-in trading at an 8% yield. So that trade didn't last very long. Those bonds are trading at about 50 BIP yield now. So to buy those same preferred stocks right now, you'd get a return on that 2 years of about 0.5% a year. But it was gone. I mean, within a matter of weeks, that trade was gone. And so we kind of have to be nimble and find those pockets of opportunity and pounce on them and make sure that we put them in adequate size in everybody's account. And so there's a 1,000 different ways to attack fixed income. And I guarantee you at any point in time, one of them is going to be cheap. The question is, can we buy it? Is it appropriate for clients? And how long is that trade going to last before somebody finds it and sucks the value out of it? So structure is important right now. Whether it be convertible bonds or floating rate bonds or preferred stock, or even what we would call story bonds, which we talked about the Owens and Minor bonds earlier, which would be an example of a bond that has a story, the credit hasn't caught up with it, and so we're going to ride those upgrades along the way. But when it's showing as being a single B bond on the really low end of the credit scale, we want to be jumping on it. So it's a lot of work, and it's a lot of banging your head against the wall because trades disappear before you can get them in size to clients. But there's always an opportunity out there.
I can confirm. I can hear Tom banging his head against the wall from across the office on a daily basis. So thanks for the answer, Tom. And thank you to Ben, Tom, Melissa, and Andrew for all the great content, and for everyone that stuck around. We appreciate you. Again, this recording will be up on our website tomorrow. Actually, probably later tonight under narwhalcapital.com/blog. And then if you enjoyed the content and you want more of this on a daily basis, we do about a 20-minute show every Monday through Friday at 8:30 a.m. Eastern Time. And you can find the link to that Zoom call at narwhalcapital.com/briefings. Again, thank you, everyone, and we will speak to you soon.